We're going to ask a trivia question. So I'm just going to do it based on whoever raises their hand first after I ask the question. So the question is, what was the first thing purchased with Bitcoin and how much? I saw a hand right there, this gentleman right here. Pizza, 20 Bitcoin. He said pizza and 20 Bitcoins. Is that the right answer? Okay, this. It's true, he did say. So go ahead. Pizza and 10,000. There we go. So just to make sure we clarify that, someone at some point in time paid 10,000 Bitcoins for 2 pizzas. So we are going to dive right into our next discussion. So we're going to take a break from the panels, and we're actually going to go for a fireside chat. So the fireside chat, sorry guys, could I just get the room to quiet down? So the fireside chat is going to be between Ted Livingston, CEO of Kik, and William Moguire, who is the writer of the Business Blockchain and producer of the Token Summit. So if we can give our fireside chat speakers a round of applause. William, I leave it to you.
So this is about the future. Everything else was about the past that you heard about before. We're going to talk about ICOs. We're going to talk about your ICO. And we're going to talk about ICOs in general. But before, I want to say to everybody here that maybe we should stop using the term ICO and use another term which is more indicative of what is going on, and that is token generation event. Because really the innovation here is the token. The token is an enabler of a business model, and it's also a new asset class, and we'll have to see it as such. Second thing I will say as a disclaimer, I am an advisor to Kik as part of their token event, and I'm also an investor in their future token sale. So Ted, tell us, why are you doing this, and what are you doing exactly with the tokens?
Sure. So maybe just before I get into that, a little bit of background on who I am and who Kik is. So I'm founder and CEO of Kik. I started Kik 8.5 years ago now, which is sort of amazing. I just turned 30, so I started when I was like 21, and I'm old now, to Ethan's point. And we've been building this chat app for a very long time. We saw mobile very early. And over the last 8.5 years, we built one of the most popular apps in the world. It's actually the number 5 most searched for term in the App Store, if you can believe that. So there's 4 terms that are ahead of us, like Instagram and Snapchat. We're number 5. That's pretty cool. But we're doing this crazy thing where we're adding a token, and we're completely changing our business, completely changing our business model. And the question people ask us is like, why? Why? You guys got $1 billion valuation at your last round. Why adding a token? Just keep going. And the reason we're adding a token, which we're calling KIN, is because fundamentally we have to. We've been working on building this consumer service for a very long time, and we've been doing that pretty successfully. But we've really struggled with making money. We're competing with these increasingly powerful companies that are the only ones that have the scale and the data to effectively monetize through advertising. And then they turn around and then they give everything else away for free. And so as a consumer company, we don't have the scale or the data to make money through ads. And we have a bunch of consumers who expect everything for free. And so we've tried and tried and tried to make money in different ways, but it just hasn't worked. But what we realized along the way is it wasn't just us. It was SoundCloud and Snapchat and Twitter and pretty much everybody else. And so we went back to this idea that we had in 2011 and sort of started testing and marketing in 2014, which is launching a new token inside of Kik, building an economy around a new cryptocurrency and using that to create a fundamentally new way to build a business and to build an ecosystem.
And you had some experience doing that earlier because you had kick points. So what did you learn from that initial experience that you're carrying through now with the token-enabled economy that you're doing?
Yeah, so we launched a digital currency, digital rewards program in 2014 called Kick Points. But maybe before that, I'll take one step back from that, which is, where did this all start when we actually started thinking about this? And it started in 2011, when we looked at Bitcoin and we're like, wow, this is amazing. You know, for the first time ever, you can guarantee the scarcity of a digital asset. So before, you could have a physical asset with guaranteed scarcity, gold, there will never be more, and you could have a digital asset like points or dollars that are easy to move around, but you can never have both those properties in the same time, easy to move around and of guaranteed scarcity. And so what we realized is, we said, wait a second, if we created our own Bitcoin, our own cryptocurrency, and created a better go-to-market for it, where now instead of people just buying and selling Bitcoin to speculate it, but people really earning and spending in Bitcoin or in Bitcoin 2.0, you know, that could be a fundamentally new way to monetize by setting some aside for ourselves. And so this is an idea we launched in market in 2014 with Kick Points. And what Kick Points was, we said, could we create a digital currency that the only way to get it was to earn it? In effect, could we build an economy around a new currency in a digital world? And that's what we did with Kick Points. And initially, there was one way to earn it, which was watch ads, and there was one way to spend it, which was buy smileys. And then we built at both sides of this economy, so there were more and more ways to earn it, more ways to spend it. And we got millions and millions of mainstream consumers participating in this new economy, in this new currency. You couldn't buy, you couldn't sell, it was just some made-up thing. But we got millions of people saying, I need more of those, I need more of those. And so that was for us sort of this proof point, wait, this could work. But it wasn't actually until 2016, no, a year and a half ago, I actually went to one of our investors, the first investor I went to, who, you know, because we've had $120 million invested in us, and I was like, hey, crazy idea. We're gonna build an economy. Because, you know, this is a new thing, this is a new space. And the person I went to was Fred Wilson from Union Square Ventures, who's invested in Kick's Series A in 2011, has been on our board since then. And I remember like sitting him down at lunch and like explaining the idea to him, like build an economy, create a currency, you know, set 30% aside for ourselves. Fundamentally new way to build business, new way to compete. And he goes, wow, that's a big idea. I'm not sure if it will work, but it might. Let me think about that. And you know, fast forward till January this year, Snapchat had just done its IPO and done its prospectus, and everybody's like, even they're struggling? They've raised $2.5 billion, they have 2,000 employees, and they're struggling? And I get this email from Fred Wilson, and he's just like, it's time. And I knew from then, like, if we could convince Fred Wilson, he could help us convince all of our other investors. And then, you know, a couple months later, we made the decision at a board meeting to go all in on this new cryptocurrency strategy.
So what you learned is that there is a utility for that. At the time, it wasn't called token, it was called Kick Points. And that is a very fundamental element of anything successful that has to do with tokens. And you're going to carry that through going into the future. Can you talk about the token functionality going forward with KIN specifically? So what will users be able to do to earn and spend these tokens?
So when I think about tokens, I think about them as a tool to economically align a large group of people to work together towards a common mission. That's my definition for it. And what I mean by that is, you have all these missions in the world, like predict where stocks are going to go, or provide computing power, or provide storage, or all these different things. And the mission is to build a better version of that, a new version of that. And a cryptocurrency is a way to economically align a large group of people to all work together to build that new thing in a powerful new way. And so for us, with KIN, we're more of a plain vanilla cryptocurrency. We really feel like we're sort of, Bitcoin, not in a technical sense, but in a consumer sense, Bitcoin with a better go-to-market, where we feel we can get millions of people earning and spending this virtual currency. But I think one of the questions is, well, you had Kick points, and that was really successful, and had more transaction volume than Bitcoin at the time, 3 times more. That's cool. Like, why don't you just take that and put it on the blockchain? And we thought about doing that. We thought, hey, we just take Kick points and we'll put it on the blockchain. But what we realized is if we just took Kick points and put it on the blockchain, it would be the most used cryptocurrency by mainstream consumers in the world. And that would probably make it pretty valuable. And then we had this idea and we said, what if we could take a big chunk of that value and set it aside to incentivize the creation of a much bigger ecosystem, an ecosystem that expanded beyond Kick. And that's why we called it Kin, which comes from family. This idea, it's like a family of digital services that are all working together, providing places for consumers to earn and spend this cryptocurrency. And the way that works is we take 60%, we set it aside, and we're going to give away 20% of whatever's left of that each year to developers to the degree that they help us grow the economy for this cryptocurrency. And so that's really the utility is, like in Kick, for example, how do we use it in Kick? We want to bring consumers into Kick, and we want to get them providing value to each other and using the cryptocurrency to facilitate it. So, on Kick, if you host a great group chat, today you do that for free. We do everything as consumers for free, and we never get paid. But now, with the cryptocurrency, it's in Kick's best interest to get people paid. Because that's what we're trying to do. We're trying to build this economy, whether it's around chat. I host a great group chat, then I join your great group chat. Whether it's music, I create a great song, I listen to your great song. A game, I create a great level, I play your great level. Where consumers are coming together, providing value to each other, and facilitating that with a cryptocurrency. The more you do that, the more valuable, the more demand for the cryptocurrency there will be. And with sort of a cryptocurrency, you can guarantee a fixed supply, guaranteed scarcity. So supply stays the same, demand goes up, the price goes up. Such that if you set some aside for yourselves and you give other people the opportunity to participate and contribute, everybody can not only build this amazing new ecosystem and platform, but also make a ton of money.
So this is a competitive advantage for you. This is how you're going to compete with Facebook. Because you can't compete with them with advertising. It's not part of your model. And I think what you're doing here is an example for other Canadian companies. And that's the second part of the topic we want to talk about. So first of all, we have 600, 500 people here. How can they help you in the token generation sale that's upcoming? How can they be involved? So we are going to do a token generation event. We've already done a pre-sale. That's all gone. That was really cool. And we'll also do a public sale. And we're setting up the public sale where as many people as want to participate can participate in a fair way. And yet the round can still be, the amount sold can still be capped. So it's sort of fair. It's not one of these crazy, like, wow, they raised how much and they only have 3 people. But at the same time, it's not just the first few in the gate get it all. So, obviously people can participate in that, go to our website. But to be honest, like that'd be cool. I'd love as many people to be part of it as possible, but that's not really the point. I think the bigger thing is this is a revolution. This is a way for everybody to band together to compete with these large, centralized, and increasingly monopolized entities. And so for us, I think it's like, one is help us build the core blockchain technology. Blockchain is just not scalable today. We need to get it to a point where it's more and more scalable. 2 is help us build the ecosystem. We're setting it up where hopefully we can give away millions of dollars a day at some point to the developers who help us build the ecosystem. We think the biggest sort of financial opportunity in the software space since the iPhone. Could be. But I think third, and a big part of why we're here is, we're actually based here. I don't know how many of you know that, but we're headquartered and founded in Waterloo. I went to the University of Waterloo. And we have an office here in Waterloo, in Toronto, New York, and Tel Aviv. And I think the last thing is, we just need people to help us with this. We need people to come work with us, join Kick, join Kin, and help us build this revolution. Because today, we're 150 people, and Facebook has 20,000. We are outgunned. And so, we have
a bunch of people from Kik here today, and they're going to be hanging out. But definitely, that's the biggest way you could help is help us build it.
Yeah, I think, no pun intended, you've kicked the door open for...
I hear a lot of puns about Kik.
You've kicked the door open for what a good token generation event is going to be like in Canada. I know we haven't seen it yet, but obviously I'm a little bit behind the scenes here with you, and we know what's coming up. And I hope that this will be the beginning of other ones in Canada, because I get lots of calls from entrepreneurs here in Canada and elsewhere in the world as well, but especially in Canada, there's a bit of uncertainty as far as the regulatory environment is concerned. So we can't talk about tokens and token generation events without talking about what the regulators think about what is going on. So how can we make it better for the other dozens of companies that are going to follow your steps?
I think, we have to work together. This is a new area, and like all new areas, there's opportunities and challenges. And to be honest, I put myself in the shoes of the regulators, and I do not envy them. They are in an incredibly tough position. And the reason is because on one side, bad stuff is happening. People are getting scammed. We are going to have to change that, right? We can't just have people running away with hundreds of millions of dollars. That can't go forever. But on the other side, this is global innovation, and therefore also the regulatory environment is also global. And so the regulators in each jurisdiction can say, you know what? We've just decided this is illegal. It's an extreme. This is totally illegal. We don't allow it anymore. And the world's going to go, great. We're going to go to a different country because this is global and this is the internet and it's totally decentralized. And the biggest challenge is you can be one regulator and say, hey, we're going to be really hard on this. But then there are all these countries who are putting up their hands like Switzerland and Singapore and saying, well, we're going to be the best place to do this. And all the innovation will move there. And so that's the really hard part. But what do you think?
Exactly. Yeah, that's the risk. And if the regulators make it difficult for companies like Kik and others to take advantage of this maybe once-in-a-lifetime opportunity, I think, the cat is out of the bag. This is it. The train has left the station. Tokens are being raised as a way, not just to get money. This is not the anti-VC kind of phenomenon. I think there is a panel later about VCs and tokens. But this is a business model innovation opportunity. When I did my token summit back in New York, this is how I started the event. I said, we're not here to discuss the price of cryptocurrency. We're here to talk about the business models that tokens are enabling. And this is really about innovation. And if the regulators make it difficult for companies, you are blessed because you have a lot of resources. You're not a small company. You're not 2, 3, 4, 5 people. And I'm getting calls from great ideas with 3, 4, 5 people that don't have the resources that you do. And they want to take advantage of this opportunity. And I hope that we can enable them to do this here in Canada, because if it becomes difficult for them to do it here, they are going to go elsewhere, because there are other jurisdictions, namely Switzerland, Singapore, and others, that are specifically making it very easy for companies to go and work with lawyers in there and make this happen.
I totally agree. The opportunity is so big on one side, but also the odds of missing out, especially as Canada, to be honest, are also so big. Ethereum was started here in Toronto. And Vitalik started here. He's from Toronto. Everybody's talking about Bitcoin versus Ethereum. One of those guys is from this city. And he left. That is a shame. It's the guy that created it left.
And many of us are witnesses. Anthony has a big role to play in it as well, of course.
Anthony stayed because,
And others.
Why did you stay? Thanks, Anthony. I just found out he's from Toronto. Good work.
I'm staying. I'm helping others, not just in Canada, but I would like to help more Canadian companies, and I'm involved in a number of them that will be doing token events in Canada. And we all have a role to educate the regulators. I mean, they are looking at us, they're looking at you, they are looking at the entrepreneurs. You are the ones that are leading the market, not the regulators. They typically follow. They follow and they try to figure it out, and they try to put, hopefully, as much regulation as needed, not more, not less.
That fine
and that is
line.
the key thing.
Yes.
Is not more, not less, the right one. And so the market is being led by people like you and others that are showing the way and innovating, really. And that's kind of the positive aspect in this whole thing. And we have to keep the optimism going in terms of allowing the entrepreneurs to lead the way. Just as a quick show of hands, how many of you are involved in some kind of ICO or token, or are thinking about doing or being involved in one? Okay.
That's why Ethereum is
That's more
win,
than half
just
the room.
FYI.
Okay. So I hope that there is regulators. Are there any regulators in this room? Anybody from the OSC? This is videotaped.
Get them! No.
We should save
I'm just
a
kidding.
clip.
They're the best. They're
This
the best.
clip is very key to what is going on. Half of a room that is involved in technology and startup is going to be involved, whether we like it or not. Now, let's make it a good one. Let's make it a good experience for everybody. And that's really the message.
Well, I think, like, as a regulator, like, I put myself in their shoes, and there's like, here's another innovation. Okay, what is a blockchain again? What did that guy say? Byzantine fault tolerance. So, like, okay, is this worth figuring out? Like, is it going to be one of those 9 out of 10 innovation that just floats on by, or is this going to be the once a decade innovation that's going to really matter? And I would say this is for sure the once a decade innovation that really matters. You cannot get to a market cap of billions and billions of dollars for this new thing for it not to be that next once a decade innovation. And so it's like you're saying, it's up to all of us to capture that opportunity, this once a decade opportunity, but it's also up to each of us to work with the regulators and not treat them adversarially and, you know, we're out to get the man. It's like people are getting hurt in this space. Does anybody think that some mother, you know, at some place should lose $5,000 because she did an ICO and a scam? Like, obviously not. Nobody thinks that. And so we need to work together, developers, entrepreneurs, businesses, and regulators to figure this out.
Yeah, I would emphasize the key thing is the role of the token. That is a very key thing. When companies contact me, the first question I ask them is, can you show me the list of what the token will do? And that is where it starts. And if you have a strong list, if you really thought about it, about how the token is going to help you to innovate, then that is the starting point. And then you go to the legal aspect, and you make it happen in a way that is transparent. So the other thing is be transparent. Be transparent. I mean, and tell the public what you are doing, and let the terms be open, and that's how we're going to go through this hump.
So maybe just my last question on that is, you know, you see a ton of these, maybe more than almost anybody in the world at this point, and you know, you're smiling, you're like, yeah, I do. But there's a lot of people in this room that won't get the chance to talk to you. You're one guy. But imagine people in this room came and talked to you and they told you about their idea and what they were doing. What would be that key decision point for you where you would tell them, you know what, I think you have something here, you should go for it, versus, I don't think this is a good application of the blockchain, I would not go for it?
Again, I will go back to the token functionality, because the innovation is in how this new asset class, the tokens are going to be classified as an asset class. There is work being done right now where it's being defined as a standard, and it's going to become accepted as an asset class. But it's a very powerful one. It's enabling something that we could not do before. So I look for innovation in how the token functionality has been conceived, how it has been thought about, and how clearly it has been communicated. And then from then on, it looks like any other startup. Then all of these companies are like a startup. Then you look at the team and at the market and whether they can execute and so on.
So you're like, make a list of the ways this token will be used and give it to me. You look at that list, and if it's a good list, you're like, let's go. And if it's a bad list, you're like, let's not go.
Something like that, and then we go back. I think we need to take a couple of questions from the audience to wrap this up.
Hey, right here.
Sure. Hi, Mike Cohen. I'm involved in a few ICOs, and you said a moment ago this sometimes is exactly like any other startup, except you're basically getting the money backwards, right? You get all the cash up front to do this project. However, traditionally with a regular VC, you'd start with seed money and then, Series A, B, C, whatever, and there are milestones at each that you have to deliver. So how do you actually ensure that people make good on these promises of actually developing what the white paper says they're going to make, and don't just run away with the money, right? Because you raised $200 million and now what?
Well, it's one of the things. I wrote a post a month ago, said 10 things I don't like about ICOs, and this was one of them. The fact that there is no accountability that is really a hard-nosed accountability. But this is where you all come in, and you have to be transparent. You have to be a little bit more self-accountable. And those companies that will be self-accountable and that will manage the money properly will do well. And good companies, good ICOs, good token events will do well, and the bad ones will not do as well. But this is one of the weak points of what is going on right now, unfortunately.
I would add, it's not even just something that's not good about ICOs or tokens or these projects. It's actually something that will fundamentally break it, okay? Like at Kick, we've raised 4 VC rounds. So we've done 2 angel rounds and 4 VC rounds, A, B, C, D, Series A, B, C, D. Through that process, we've raised $120 million, US dollars. Amazing. Every time we raise money, we raise roughly 18 months of burn, which means that after 18 months, we die. That is a really good incentive. You know why? Because for the first 6 months, you sort of exhale. We didn't die. Good. Then for the next 6 months, you go, shit, we really better figure out what we're doing because we got to raise the next round or we die. And then you have 6 months to go out and raise the next round. And that has been one of the best motivational tools to really figure it out and really execute. And that's what I really I worry about with some of these ICOs is if somebody gave me $200 million, and it was me and my couple buddies, I would not be a bad person. I would not run away. But I might chill, okay? Because I'm like, we literally have 200 years of runway if we all buy ourselves amazing cars every year and anything we ever wanted. It's just way too much money. And when you have that much money, you just don't have the gun to your head. The gun to your head is actually a really motivating thing. And so I think this is something we will see. This is early days in the ICO market where, we're going to see these projects. A lot of them are not going to pan out. And people are going to say, and then one is going to pan out. And they're going to say, what did that one do differently? Let's do more of that and less of that. And so I think it will be this iterative thing, but I think this is probably the biggest problem with this new model.
I would add, surround yourself with advisors and mentors that will help give you this kind of discipline that you may not have on your own. And that's another tip.
I think we have time for one more question.
Right, so you talked about the functionality of tokens.
Francis.
What I see, there's 3 major ones. One is to... Right, so you talked about the functionality of tokens, where I see there's 3 major ones. One is bootstrapping a blockchain, like Zcash and Ethereum did. The other one is digitizing assets that can be transferred peer-to-peer, that are most of the time backed by a service or good which is created with paid for with US dollars or redeemable in in some kind of priced in like some kind of national currency, and the other one would be for fundraising. So assuming that you're using an existing blockchain like Ethereum to do an ICO, then you don't really have to worry about bootstrapping the consensus. Then you have fundraising and you have digitization. And I'm wondering, why would you do two at the same time with the same token? And the specific question is, if you're good, that you're, I don't know about kin, but assuming that you can use kin to spend for something that has US dollar value, why would you want that to be traded? Why would you want that token that's spendable for, like, it's like Starbucks gift cards. You don't want to be traded, they're just worth that. And so, and if you do a fundraising, then why would you want it to be consumable? So why don't you just do an IPO? And why don't you tokenize an asset without linking it to your fundraising? Why, merge the two together?
Okay, so I think this is a narrow classification, the one you've just named here. You have to think of the token as an innovative tool to enable something that is work-related. So if you think about it, the genesis of Bitcoin was that miners had to do some work, and that's how they got rewarded. Now humans are doing the work. So somebody has to do something to earn that token, and that is really the basic way of thinking about it. And it could be a right, it could be something that they create, it could be something that they earn by maybe doing responding to a bounty, or so there's no classification. The sky's the limit. It's the entrepreneur's ability to dream and to innovate. It's back to basics, innovation. And there's no limit really to what the token can do. And that's how you have to think about it.
Is that logic in the business logic, or is the reward in the protocol? So you have your own protocol with people that are generating, like, are you using Ethereum, for example, or is that logic in the business, the reward, like reward points, like, or is that logic like on the blockchain, the consensus?
There are many ways to implement it, so we shouldn't go into that, but there will be many ways of implementing it via your own blockchain, or in the protocol, or in how you do the gaming of it. So some of it could be a gaming kind of thing, but then it gets committed to the blockchain, but it's an implementation.
I think, like, for me, there's two things I like about cryptocurrencies versus, a digital currency like Kick Points. The first is it is global and frictionless. So what that means is now, as a consumer or developer, if I'm contributing value to this ecosystem, whether that's kin or anything else, no matter where I live, and no matter how much value I can contribute, I can get compensated for that. I love that. So if you're some kid in India who hosts a great group chat and creates in the world 1 US penny worth of equivalent value, we can get you that value. So I think that's number one thing I love.
Yep.
The number two thing I love is once you get it, it's yours. Nobody can take that away from you. So not only did you get that penny, you got compensated for the value you contributed, but you now forever know that in the case of kin, if you get 1 kin, there are going to be 10 trillion kin. You will have 1/10 trillionth of all kin in existence to do with whatever you want for the rest of time. That is cool.
That is the future of work you've just described. And that's it. Thanks very much.
Thanks.
Thank you, Will. So as we transition for the next panel, just actually a raise of hands. If you look to your left, your right, if there's an empty seat, if you can raise your hands. So folks actually standing around, if you want to look for those hands and make a new friend and sit on down, that would be great. I'll just give him 1 minute. Give him like 30 seconds. I'll just give it for like 30 minutes. Oh, I was going to introduce you on. Yeah, you're going to introduce us? I'll introduce you. Okay, cool. No, we have... Yeah, I'm not going to lose control. I need the other... I'll give you this one. I'll give you this one, and then Agisan should have the next one. That's good. Okay, folks. If you guys can take a seat, we're going to get started on our third panel. Okay, folks, if you guys can take a seat, please. Okay, folks. So for our next panel, a lot of recent news in Bitcoin has been the rise of its price. But prior to the recent major rise of its price, a lot of conversation was on scaling open blockchains. And so what we decided to do was bring together some of the movers and shakers in the space here and talk about scaling open blockchains to billions. So from left to right, we have Joseph Weinberg. He is the moderator and the CEO of Paycase. To his right, we have Rodolfo Novak, CEO of OpenDime and CoinKite. From there, we have John Dilley, product architect at Blockstream. And lastly, we have Adam Back, CEO and co-founder, Jameson Lopp, software engineer at Bitco. My apologies. Unfortunately, Peter, Todd, and Adam Back weren't able to make the discussion tonight, but Joseph will definitely make it interesting. Take it away.
Thank you. Okay, so before we get started, we have 30 minutes, and this has been a massive, massive conversation. Scaling is very complex, and how we get to the next billion people over open blockchains. I think that this panel is probably more specifically focused on Bitcoin scaling, but we'll try to get it in the next 30 minutes as much as we can. I also think that it's just good for everyone to stop and just think for a minute and all the people that you actually have here today. These guys, I think, have been amongst some of the most influential people who have been involved in scaling the largest open-based blockchain protocol that we have today, and have been kind of fundamental into that. So I just want everyone to kind of preface that. All right, so we're going to kind of get into it and really start with the first question is, what is the most important thing or set of things in a public blockchain? And kind of, we're going to kind of just go back and forth and kind of discuss what are the core fundamental characteristics that you look for when you're scaling a blockchain, and what does that even really mean?
Hey. Yes, I'll start. I think the most important thing that you can have in a blockchain really is what Bitcoin is. It's a fully fungible value store, and that really is what brings the value to Bitcoin. Anything other than that is just extra. I'll keep it simple.
Hi. I actually think that question is probably too nuanced to even finish if we spent the whole 30 minutes on it. But I'll speak to 2 points. One, that changing the system is fundamentally difficult, and changing the system is not subject to the control or influence of a single person.
I guess I'll kind of piggyback on that from my standpoint. The important part of these crypto assets, these cryptographic protocols that are giving power to the individual, the important part is that we give the individual as much power, we allow them to retain as much power. And so when we're talking about scaling, that generally means that the individual, if they so choose, has the ability to verify the entire state of the system on their own without trusting anyone else. And this is when we start talking about trustless protocols, which Bitcoin was really a major innovation. And so a lot of the contention that you get into in this debate is people who are willing to make trade-offs with that, and other people who are just unwilling to compromise on it.
Yeah, I think what Jason sort of like puts it out there is very important, is the idea, what gives Bitcoin fungibility is the fact that everybody knows how much they have and how much they're entitled to on the chain. And when you scale this, you got to make sure that everybody retains their right and retains the right of spending what they owe. Yep.
I'll expand more. So fundamentally, when a person buys some Bitcoin, they're opting into a set of rules that's known by every other existing Bitcoiner. And everyone is currently agreeing about all those rules. And the means by which a person knows they are using Bitcoin, knows that their Bitcoin are legitimate, is because they can validate in real time that the system is still running in those rules. So fundamentally, and I spoke a little bit about this, like a snippet of it, it's that you never have to change what rules you run in Bitcoin. No one can make you stop validating the current rules. If someone tries to change or add rules to the system, if someone tries to delete rules from the system to make it in a manner, you are under no obligation to follow that individual or individuals' new chain or new rule set. And that's very empowering in the context of the fact that humanity has never had that before for a monetary asset, ever.
Yeah, so we talk about consensus a lot in this space, and there's really several layers of consensus. And the way that I see it is that what we are doing here is we're developing a technology that allows us to automatically enforce the consensus that we come to at a human level amongst each other of like what the rules of this system should be. We then write software, we write code that describes those rules, and we can then just put that on a machine that we own and have it automatically enforce the rules day and night, regardless of whatever we're doing, and we can be assured that the rules that we have opted into are going to be followed, at least from our own perspective of the system. It then gets a lot more complicated when you see disagreement at the human level and start talking about all the things that can then happen at the machine consensus level with forking and whatnot.
And what keeps these rules in play are the incentives. And they're sort of intertwined, right? Like the incentive causes the rule and the rule causes the incentive. And this makes sure that nobody can sort of like take over the system and change the rules. And they sort of reinforce themselves in this circle. At least that's sort of the simplest way I can put this.
Yeah, I think at the end of the day, really what it deals with is the alignment of economic incentives and the inability for one actor or even a set of actors to change the rules unless consensus is reached over a broad-based majority of those people. And your ability to not change the system by even a mediocrely or large group of actors without consensus is really what it comes down to. And I guess that kind of comes into the next question as well is I think that we've looked at the scaling debate for people who are new to Bitcoin. I think you might have probably heard of it, is that Bitcoin has found what's called a scaling solution, or Bitcoin's been in a fight for over a year and a half. And I think there's kind of camps on the Ethereum side who have a much easier time kind of scaling, if you will. And so I guess like a good question that I kind of always have is why is Bitcoin scaling contentious? Or is it supposed to be? Is it hard? Is it that we can all come to an agreement? What is that? So maybe you guys can kind of shed light on it.
Sure.
So this is a pretty massive moral, social, political, and economic question about how and why we do things to Bitcoin. And from my perspective, I've been Bitcoin for about five-ish years. Bitcoin is humanity's last hope to remove control over money from those who also have fiscal control. Fundamentally, it represents an opportunity for humanity to have a system whereby assets that they own cannot be inflated away underneath them. And that's a very powerful, real, unpopular to some idea, but fundamentally that's what it represents. It represents a human's right to own their own assets and not have it not be there except under extraordinary circumstances, not be able to lose control over a fixed portion of all assets. And when you talk about making modifications to that system, there are those that have been there longer than you have who bought into a set of rules, and there will be those who come after you who buy into a set of rules. So when you approach how you want to think about Bitcoin and maybe making it better or maybe making it different in a certain way or adding new things to it, you must take into account that changing even the smallest thing in such a way that it breaks something that's critical or it undermines even the slightest, tiniest portion of the incentive structure that keeps Bitcoin working and keeps it moving forward could endanger that greater goal.
But on the flip side, because this is a permissionless technology, anyone is free to leave, or they're free to fork off. They're free to fork the software. They're free to fork the history of the ledger. If you can create a new human consensus around a new set of rules, then you can migrate some portion of the existing network over. If by some miracle you can convince everyone, then you can, quote unquote, upgrade the protocol in a non-backwards compatible way. But a lot of us believe that this technology, this ecosystem has already grown to the point where it's nearly impossible, if not completely impossible, to make breaking changes that you can get everyone to agree to. And we saw just a few weeks ago that a group of people did manage to fork off and create a new network. And now we're going to get to see how well they operate and manage that network over the long term.
Yeah. So one of the beauties of it is the counter incentives, right? Bitcoin is different things for different people. And when you have competing incentives, you have a very tall challenge to convince enough people to believe that you have consensus, because it's very hard to tell how many people sort of follow your consensus too. So in order to make this change, you really have to really get a lot of people involved in this. And that creates a huge challenge. For example, with USF, we sort of had enough people behind sort of putting pressure to make sure that this other group of people that wanted to make this change to understand that their change was very contentious. And it was actually shown a lot in the price. You can see that it's 10 to 1, 10 to 0.7 now. The market is not following the other chain. And you can see that in the amount of nodes, the economic majority, it becomes very clear that this other idea wasn't as good or as interesting to the majority. And that's sort of like the defense mechanism that Bitcoin has, is this consensus incentive.
Yeah, and I think that kind of just to kind of underlay that is that I think kind of to answer that, is it being hard a bad thing, right? And I think that what you're seeing is that the fact that it's so hard to scale Bitcoin is proof that the actual governance rules of the system are working. The idea is that if it was easy to do it, and everyone was able to change that choice very simply, then you're not enforcing the fundamental rules, which makes it hard to change, which is the point, is that your money is not supposed to be easily adaptable and changeable whenever someone says, oh, let's change the rules, let's increase the money supply. And so I think that the enforcement of those rules is the proof that this grinding and this constant backlash is actually really important for the ecosystem. You guys would agree.
The adversarial system is really, the adversarial system is really what keeps it standing.
What he's actually saying is, if you're not running a full node, you don't own your Bitcoin.
That's right. It really is the only thing that makes Bitcoin Bitcoin. It's the fact that you have a copy of the ledger that proves that you have what you have. That's it.
Okay, so we do have to get to questions as well, so I'm going to leave time for that. So I guess the big question that we have is, where are we going? Now we have the scaling solution in Bitcoin specifically. How do we really answer the question of how do we get to the next billion people, right? How do we take these solutions to the next level?
We have SegWit now about to be fully in effect, and that fixes a lot of bugs, and that enables second layer systems to be more trustworthy, right? Malleability was a big issue that didn't allow us to use a transaction that's not confirmed, so that really didn't help with things on second layer. Now, if you need to transact millions of little bits of money, it's very hard to do that on a blockchain, right? It's the most inefficient way to store data that I know of. And we have databases to do that on the other side, so you have to do it's a cost problem, right? Is this transaction big enough to be worth to be in this system that's inefficient? If not, then you put it on this other layer. And that's really the only way of scaling Bitcoin.
I'll speak more to some proposed upgrades, and obviously nothing in Bitcoin is guaranteed. I think if anyone has been following the state of things for the last couple of years, they would know that nothing is guaranteed. There's an interesting technology called aggregated signatures, which comes from a previously patented technology called Schnorr signatures, which gives us the means and methodology to basically compress multiple transactions inside the same signature state. So that's another substantial capacity increase. It's also a massive bump to fungibility and a number of improvements for things like the Lightning Network, things like the Liquid Network, things like OpenDime, stuff like that. Besides that, when it comes to, I mean, obviously in a broadcast network, you fundamentally start to hit up with limits between how much does it cost to store the information about everyone in the world transacting versus, for example, just storing representations of the fact that many transactions happen. So we have things like Mimblewimble, which is actually fascinating if you haven't heard out about it. It's the name itself comes from Harry Potter. I'm sure all of you have heard of Harry Potter. It had to do with the secret sharing methodology the Order of the Phoenix used to keep their safe houses safe from the Death Eaters. And essentially, you entered into a secret partnership such that it was not possible to give up the information. It's why the Longbottoms are insane and Neville Longbottom is so weird. Essentially, it would allow us to store proofs of information inside Bitcoin signatures from parallel networks, and you can prove the validity of those transactions without needing those transactions to be part of the Bitcoin network, which would be super cool. Gets us a whole other order of magnitude of scale. And then obviously there's the more, I'm a big Bitcoin physical guy, so I actually like things like KLR, I like things like OpenDime, like those markets have done very well, by the way, if you haven't been following them, Bitcoin physical markets. And the method of bearer transactions with using Bitcoin where you have structural validation of the actual device or the actual art piece are also pretty interesting with regards to scaling out more.
Let me try to bring it up a little higher level here. So there's two main ways of quote-unquote scaling these technologies. You hear on-chain scaling, you hear off-chain scaling. On-chain scaling means we continue making transactions the way the network currently operates. You make a transaction, it gets broadcast to everybody in the entire world. And so we question, is this transaction really worth telling the entire world about? Probably not, unless it's very high value. On the other hand, an off-chain transaction is where you create some data, and then you just go over to the person that cares about the data, and you say, hey, here's a transaction. We don't need to tell the rest of the world about it. And so that's what these second layer networks are more like. So I think, mentioned earlier a broadcast-only network, which is kind of like what the low-level internet works like. You probably aren't familiar with all the network stack and whatnot, but broadcasting to everyone is what happens at low-level Ethernet connections on the internet. However, if the entire internet worked like that, the internet as we know it would not work. Instead, you build layers on top, which are routing the data specifically to the parties that need to know about it. And as such, you can then have, on the internet, communication interactions that are highly efficient and trustworthy. And we want to do a similar thing with Bitcoin, where instead you'll be having economic interactions that are only routed through a minimum number of participants on the network in a much more efficient way.
A very good example of the efficiency of an off-chain transaction is, he gave this to me, right? And there was not a Bitcoin transaction here. It was only done once to put it here, right? Now I'm going to exponentially transact that.
Infinite scalability.
See, look at that. We can just keep on passing it around. Isn't that wonderful? It costed nothing.
None of those were Bitcoin transactions. And this is why I'm so interested with things like the Lightning Network. It will fundamentally change the way in which humans transact with one another. Because, in that you will know, from the moment that you transact with a person, once the Lightning Network exists, you'll have a relationship with them, and such that if they have a relationship with someone else and then through someone else, you'll be able to pay seamlessly and trustlessly, and in the event that anyone tries anything untoward, you can just settle to Bitcoin and the dispute is resolved. It's an amazing piece of technology.
All right, we could probably talk about this for like months. We probably actually all have been here on stage. But I think we're going to take it over to questions and ask the audience if you have any questions for anyone up here.
With the event of user-activated software, Rodolfo is wearing a hat to show it. I got a question. So that formed a precedence that we didn't see. The debate was going on and on for over a year about how to activate SegWit. So the question to you, wise guys, is are we changing the activation method, or are we going to keep on with the mining activation and we're going to go over and over this battle every time? And then one more question to you, because you're a representative of Blockstream. Can you shed some light on the satellite video, or like that announcement that you guys did today?
So I think we were supposed to show a video about it, but the sound doesn't work, so we didn't show it. But that's just to help better relay across the world so everyone has better access to the current consensus without there being middlemen between them like their data provider. So you're not leaking necessary privacy to your data provider. Because right now, running a full node over an ISP, unless you're doing it via something like Tor, or you happen to be someone low level enough like Jameson, you're not going to be able to obfuscate your traffic enough to not show the world, or at least your ISP, and via them, Prism, basically what your traffic is. But to speak to the first point, so it's complicated and complex. Complications in the sense that if your surgeon comes out to talk to your family in the middle of heart surgery and he says there were complications, the heart surgery did not go well. And complex in the sense that heart surgery is hard. So it's complex because as Bitcoin Core contributors, as people who add software to this system and seek to make it improve and get better, there's both moral hazard and just a difficulty of actually figuring out what consensus about evolving is, and a lot of that has to do with balancing trade-offs, and that can be difficult. And then it's complicated in the sense that, and Rusty has a great piece about this. BIP 9 was not designed to make it so that miners were voting on improvements. Miners are essentially in the system, they are supposed to be as dumb as possible. You validate, you validate that a block is valid, and you post it. And that you are literally just advancing the chain state. You are not in control. You do not delineate how the system will advance or how it operates. And in fact, more control to miners is a terrible thing. In fact, there are components of Bitcoin right now that miners have quote unquote control over that are not good. For example, they get to choose which transactions get included in blocks. And that is an attack vector in Bitcoin right now. And it's something I work on improving via things like fog of war and stuff like that. But so it's complicated and complex. If you're on the IRCs, you can participate in GitHub. It's not really well known. There's proposals like BIP 8. There's proposals like UASF and BIP 148. There's proposals like 91.
Yeah, I just add one thing. USF is not contentious. It's part of Bitcoin. It's being used before. Satoshi created USF as a way of updating the client. Like there's really nothing contentious. It was made contentious.
I think we have time for one more question right here.
Thanks. Oh, I'm getting it from both sides. The one sitting no. Okay, we'll be around to talk about this tons more, because I'm sure there's more questions. And thank you guys for everyone who came.
Okay, folks, we're going to go right into the next panel, which is actually the panel I'm looking forward to most, venture capitalism and ICOs, or known as initial coin offerings. So if I can invite to the stage Jim Orlando, he's the managing director of Omer's Ventures, Matt Spoke, CEO of Nuco, Addison Cameron Huff, tech lawyer for blockchain startups, Trevor Koverko, co-founder of Polymath and investor of Shapeshift, Matt Sabula, CEO of Cryptiv, and moderating will be Kyle Kemper from the Blockchain Alliance of Canada. Are you good? Yeah, folks. And for folks standing on the sides, seats have opened up, so please feel free to sit down, get comfortable, and listen on to the last panel. Take it away, brother man.
Thank you. All right, everyone. Well, thank you so much for the wonderful patience, and we're almost done. This is a really exciting panel of some industry leaders, and we're going to be talking about a topic that I think is hot on everybody's mind these days, which is ICOs and the future of venture capitalism, as we're calling it. So for anybody who doesn't know, ICOs are called, I guess, initial coin offerings, but it's a new way that companies are raising funds for projects. And in the last little bit, we've seen some incredible kind of success stories. Last week, Filecoin raised $100 million. We had Tezos, right? Anyways, we had Tezos, 250. I don't even know, but there's a lot that are happening right now.
You got to get your hundreds of millions right.
Hundreds
it's
of
tough
millions.
to keep track. Yeah.
And on panel tonight, we've got a couple of people as well who are prospectively launching ICOs and can share more insight about why it's a new kind of paradigm for investing. And we also have Jim Orlando here from OMERS, who is the traditional venture capitalist who's looking at this space and has some excellent insight as well. So why don't I pass it along? We'll do quick intros, and let's get the discussion started. Also, if anybody has any questions, I'm just Kyle Kemper on Twitter, and feel free to shoot me a tweet, and we'll get to them if they make sense.
So it's intro?
Intro.
Yeah. Jim Orlando, OMERS Ventures. As Kyle said, we're more of a traditional venture firm. Interest in and around this area is really, we have two investments now in the, I'll call it Bitcoin blockchain sector, one of which is a hedge fund that participates in some of the ICO and alternative coins beyond sort of Bitcoin and Ethereum, and I'm sure we'll talk more about that as we go on. And our interest more specifically in the area is looking at both companies and tokens themselves as potential investments. So here to offer a bit of perspective on that side of things.
I'm Trevor Koverko, CEO of Polymath Project, and we're trying to interface financial securities with the blockchain. And this all started when I wanted to tokenize my private equity company. And I said, hey, we're going to pay a dividend, we're going to have voting rights and all this fancy stuff. And it occurred to me that it's really hard, that securities and the blockchain don't interface very easily. So we said, why not make it easier for other projects to launch on this platform that are securities instead of just solving one individual problem.
My name is Matt Sabula. I'm the CEO of Cryptiv. At Cryptiv, we create enterprise wallet systems, and we also help institutional investors get exposure to this emerging asset class.
My name is Addison Cameron Huff, and I help structure the companies that do the token sales and write some of their documents.
I'm Matt Spoke. I'm the CEO of Nuco, founder of a new project called Aeon. We are not promoting a token sale in Canada, but we are launching a token.
So Jim, have you invested in any kind of ICOs to date on behalf of OMERS?
No. The closest, as I guess I mentioned in the intro, closest we've come to at this point in time is investing in a hedge fund, which ultimately has invested in some of the ICO or tokens that are available. From that standpoint, though, there's nothing preventing us from investing in either companies that issue tokens or tokens themselves, and looking, strongly at that. But for now, kind of walk before you run.
So how do you think, from my perspective, I feel ICOs open up the opportunity for companies to raise capital from the public, very quickly. And as opposed to in the traditional method where you would have been, as an entrepreneur, you'd go and you try to raise money from traditional investors, you'd have to go to each one. And a lot of time would be spent on actually kind of convincing people that your project was something you wanted to get behind. But now in this digital age, we have the opportunity to do kind of public due diligence with the world at large. And if you put out a beautiful story, not everybody's necessarily going to get it, but all it takes is a very small portion of people to kind of get behind it and believe in it. And the next thing you know, your project has enough resources to go to the next level. Does anyone else want to have any thoughts about just ICOs in general?
I think we were joking earlier about just all bashing on Jim for being a VC, but I think to his defense and to the defense of VCs in general, I think what's missing in our industry, and we're going through this process right now, is that capital is abundant right now. It doesn't take much for a project to go out and raise $1 million overnight, $100 million over a day, whatever the case might be, depending on the merits of the project. What's in a dire shortage is experience and people who know how to actually scale projects. And this is not exclusive to our industry. We look as insiders into the crypto industry and we say, who can help me do this and who's done this before? The reality is that there's tons of experience from outside the crypto industry that would be really, really valuable to us. And this is where venture capital has traditionally come in beyond the check. It's people that have experience observing other companies, in some cases, operating companies before they became venture capitalists. And we're going through this process right now as part of our original token sales. And the best buyers we can find are buyers that have done something of these scales before. I came back from a trip to Shanghai, realized that quite simply, if I had put a QR code on screen, I probably could have raised $10 million while standing on stage. But none of those people sending us money would have had any kind of value add beyond that money. And I think this is where we need to find the right balance. Ted was talking about this a little bit earlier about, what is that accountability structure? What's that gun to your head? How do you make sure that there's maturity around what you're doing? And this is where I'm hoping we see more and more established investors and former entrepreneurs and current entrepreneurs getting involved in projects and helping kind of make sure that there's proper stewardship after we raise all this money.
What's interesting to me, coming from private equity, is the structure of these deals. And it's very interesting because there's no standard that has really emerged yet for these token sales. Pretty much every major token sale has had a different structure. And there's some terms coming up like token mechanics and token allocations. And this is a very important decision. It's one we've struggled with a lot, is how do we structure our token sale? Do we have a pre-sale, which is kind of like a convertible debenture that converts at the next round of funding, in this case an ICO? And if you do a pre-ICO, do you go a level deeper? Do you do tranches within that pre-ICO? Do you give discounts to kind of early adopters, family and friends, and then have a sliding scale to incentivize people to take action? Do you keep it simple? Do you use traditional sounding agreements? There's an agreement called the SAFT, the Sale of Future Tokens Agreement, that's kind of emerging. And everything's very unclear right now, and it's actually a lot of fun. You're seeing a lot of fancy types of auctions coming up, Dutch auctions, reverse Dutch auctions if you're feeling frisky. But it's really full. We can go in and we've kind of decided to take a more vanilla approach. We don't want to reinvent the wheel. We want people to feel comfortable and focus on the project with our mechanics. But if you look at a project like Filecoin, a lot of people argued they had a very founder-friendly token allocation and token mechanic structure. But what do I know? They raised $250 million. So it's just fascinating to me to see this structuring debate unfold.
It's interesting. Just on Filecoin, I think it's well publicized that there were venture investors who bought those tokens. So it may have been, sort of founder friendly, but the fact is venture investors have seen their way towards investing. Now, I think some of them were investors in the entity in addition to the tokens, so in many ways supporting the company. But I think that's a big part of the answer I had for you earlier around, why haven't we purchased any tokens now? One key element, and there was a conversation earlier as well around this, if the money comes first, and the individuals who either have these tokens or have the money, are able, to kind of walk away from the project, then the years of kind of structuring that has gone into how the venture industry and startup industry works with vested stock options, typically over a 4-year period. If what we're starting to see is now 3-year vesting or up to 3-month vesting up to 12-month vesting. It's still not at 4 years, so it makes it a little difficult as a venture investor who, it's not sort of say this is absolutely the right way, but I think the industry migrated towards that in order to incent individuals to stick with the project to create the value that takes years to develop. So part of our hesitation specifically on tokens as it stands now and around that structure you're referring to, Trevor, is it's got to be a little bit more towards what we're normally investing in, for lack of a better characterization.
Yeah, I would say there's sort of two sides to it. On the one hand, there's definitely a bit of a mania, and there's companies and projects that are raising money that really shouldn't be raising as much money as they are, and there's a lot of people that are going to lose a lot of money, and it's going to cause problems. And so it's a bit of a gold rush at the moment. But on the other hand, if you really take a look at this, you really see the evolution of capital markets occurring before our eyes. There's people that are raising money with good intentions, and they're creating tokens that have really unique incentivization models. They're creating legions of fans that are investors as well. And I think this is just sort of the beginning. And it's starting with venture capital, with this ICO phenomenon. But you could very well see that the next step could tackle another sort of pillar of finance. Because a lot of these projects, they're raising money to create another project on top of the blockchain. So they're raising $50, $100 million. They're bringing in a lot of talented engineers and a lot of talented individuals, and they're trying to create peer-to-peer trading. They're trying to create peer-to-peer lending. They're trying to create a new payments rail. And even if one of these things works out, the whole game has changed. And so I think on the one hand, it's, buyer beware, do your homework, make sure you're not putting your Bitcoin or Ethereum into some shitty shitcoin that's not going anywhere. But on the other hand, pay attention, especially if you're in the world of finance, because I think the ground is shifting beneath our feet. And my personal belief is that money is kind of like water. It finds the fastest way down the mountain. And right now, Bitcoin and Ethereum are creating a better way to move down the mountain, and it's kind of just the beginning.
I think these things are a little more complementary than they first appeared, as Jim was saying, about VCs investing as well as people doing the token sales. Although there's a really interesting angle where the token sales are undermining the VCs because people have made a ton of money off of Ethereum, Bitcoin, these other tokens. And what do they do with the money? They put it back into the ecosystem where those people become angel investors or they self-fund the companies and they don't need the VCs anymore because they already have the money. So I think some of it is a recycling of money, which is also hurting the VC side of it.
As an investor, you have to ask yourself a binary question. Are you a speculator and just a technical analyst and just riding the wave or the momentum? Or are you an investor? And if you're an investor or claim to be one, you have to do the legwork. You have to read the terms. There's always two pie charts you want to look for before you invest in an ICO. You want to look at the token allocation. Where are the tokens getting allocated? How many are in reserve? If you have 50% or more in reserve, that's usually a red flag because they have the power to potentially move the price or cash out. You want to look at, are they vested? How long, if so, and is there some kind of cliff at the beginning like Jim would look for in a deal? And the other pie chart you want to look at is use of proceeds. Where are they spending their money? Is it well thought out? Do you have documentation that supports that? I do a lot of investing in these projects myself, and I'm guilty a lot of times of just following the crowd. But I think as this market evolves, you'll see the investors are going to win out over the speculators. So I would encourage everybody who's looking at ICOs to really understand the terms before you do so.
So one of the sponsors tonight is Ucash, and they're kind of taking a little bit of a different approach to the whole ICO, and they're doing this thing called an IBO, which is like an initial bounty offering, and there's lots of people around who can talk and explain it. But What's really interesting from my perspective on what they're kind of doing is they're basically breaking down the entire project into bounties and then making it so that investors can come in and act as benefactors and basically fund the development of specific initiatives, but also the community can come in and execute certain bounties themselves and earn the tokens. So it's almost like, you know, they're incentivizing people to start building and contributing to it in a defined layout. And this is like, you know, it's different than just the notion of trying to buy, you know, the membership token at a discount, like say the SALT kind of approach to it, and then we'll utilize it later. But you know, that's one thing that I'd like to highlight and give them a shout out to. One of the other things I want to say just before we go on to questions is, are ICOs going to affect business models that don't have to do anything with crypto? Can nonprofits use ICOs, for example? Any thoughts about that?
Yeah, I mean, I have to think a bit more about nonprofits, but probably my guess would be yes. But just want to offer a comment of 30 startups that we've invested in Canada, across the country, 3 in Vancouver, 2 in Halifax, all the rest in between. 8 of those 30 are considering, you know, some form of ICO, or really is there a way that they can, you know, leverage this whole sort of movement. I think that's a really positive trend. And so, you know, yeah, here I am as a venture investor, but I can tell you on the other side of it, for companies we're currently invested in as a venture investor, every board meeting we go to, you know, there is a conversation around this because there's a fundamental business model shift that can benefit companies that are not specifically part of the crypto or blockchain world. You know, absolutely believe that.
And I think maybe one step further, and that benefit companies, of course, but I think, you know, companies that 2 years ago were the most innovative in their fields are going to be facing disruption challenges themselves. You know, there's tons of tech companies that have built themselves around sitting in the middle of a peer-to-peer transaction. And, you know, in all of these scenarios, whether you're a 100-year-old established, you know, bank, insurance company, whatever, or you're a 2-year-old startup whose business model is built on the model where you're rent-seeking in the middle of a transaction, this changes things. And so absolutely, I think the token structure, the token concept impacts a lot more than the crypto industry. I think, you know, where we're particularly focused is we're looking at the overlap of like, how do public blockchains, token systems start to overplay with the enterprise world? I mean, we've been focused on building enterprise blockchains for a few years, and we're starting to get these conversations and questions coming from, you know, the types of companies you might not expect that are looking at, can we hold balances of crypto assets? Can we digitize our own asset classes? Can we create private systems that connect to public systems? And this is kind of the crux of our focus. So I think you'll be hard pressed to find an industry where this doesn't apply. And I think you'll be hard pressed to find an industry, startup or mature, to which this is not going to be a significant force of disruption that people have to pay attention to. And if you're a startup that's not a crypto startup and you're not having a conversation about, does this change something fundamentally for us, you're probably a few months behind the curve right now. So,
Final thought, we've got some questions now.
I have clients all the time asking me about the nonprofit route. They're picking for-profit, nonprofit, and the question is, where's the value? In the normal investing world, the value is in the company and the shares and doing that. But with companies that are issuing tokens, the value could be in the shares or it could be in the tokens. In some cases, the company might have almost no value. Or you could have things like Bitcoin, where there is no organization that benefits from it, but everyone can use it. So there's a huge variety of models here, and the token aspect of it changes where the value lies and changes the kinds of entities that people are creating to deal with these.
One other insight I would encourage all of us to think about is this inherent sampling bias that we all have. When we see something like Filecoin launch, our brain automatically thinks that every token is Filecoin or every token is Bancor. They're all 9 figures, but you don't see or hear about the failures, the ones that weren't executed properly. And the reality is, it seems very spontaneous which companies emerge, which projects come out and raise 9 figures, but it's actually not. There's, like we were saying earlier, there's these capital market groups and syndicates and whale groups that kind of anoint your project as the next big one. And they're the ones with the reach to get the message out. You need to hire the right PR agency. You need to hire the right investment bank. There's all these crypto investment banks coming out that get paid based on how much you raise. So you have to be very strategic, and you have to find the right nodes and the right influencers in the market. You can't just release something and then think you're going to explode. That's not how it works.
Okay, so we have a Twitter question. Jim, what do you think of ICOs as a way for institutional investors to gain exposure to crypto markets versus the friction and high cost of using exchanges? So I'd say maybe something like the economy kind of token there. Any thoughts?
Yeah, I think from institutional, I guess depends on your risk profile. Our largest funder is an institution, and all of our other funders actually are, the Canadian banks and insurance companies. So from the standpoint of what we do at OMERS Ventures, I think we're the highest risk asset class in a $70 billion pension fund. And, we don't want to sort of dip into any one individual currency at this point in time. So I think the answer is part of your risk profile. The reason I'm saying that is fundamentally, the elements of, what are the use cases? What do those pie charts look at? I think you have to look at the devil in the details. I'm certainly not in a position to make any recommendations, but if you're looking for access to, crypto and digital currencies, Ethereum is the foundation for a lot of these things, so that might be a different way to go at this as a suggested thing to look at. The other part of it that I'd add on to, assuming this is someone in the audience and they're based here in Toronto, it's been a disappointment for me, and I think probably everyone here. I'm excited to see the number of people and to hear some of the thoughts that Ted had, for example, in the previous panel. But to the best of my knowledge, there's been one or two Canadian kind of entities that have ICO'd. Ethereum, of course, as a side, as a sidebar, as a major success. But I'm hoping we're on the cusp of Canada really embracing this. There have been somewhere on the order of 150 plus ICOs thus far, $2 billion raised in total, and one or two Canadian entities. It just doesn't feel right given the the level of brain power we have here, the roots, the people. William hosted the token conference earlier this year. The Tapscots have written the book around this. Vitalik, obviously, so many of the major sort of players, and I think it's a real opportunity for us all to embrace this. I can tell you, we as a venture firm are 100% behind this. If there's ways we can help out, let us know.
All right.
So that's a big, long answer to how can an institution participate?
I think there's lots of ways you can help out. Okay, we got a question over here.
Hold on 1 second. Sorry. Right here. Sorry. Yeah, sorry. We'll get you next. Are token securities?
I like this question. So I don't think anybody's got, or if anybody claims to have an answer for you, there is no answer right now. I think the best we can do, and we're going through this process pretty diligently right now, is seek a lot of legal advice in as many jurisdictions as possible. Because the problem with securities law is that it doesn't matter where you are domiciled as a company, it matters where your investors are domiciled. And the moment you start talking about raising global funds through cryptocurrency, your investors can be domiciled anywhere in the world. And this is why companies around the world are concerned when they see the SEC coming out with guidelines and we know that the OSC has been looking very closely at this, of course. It's something that you have to be very specifically looking at. There's the general test that we've been going through kind of circles around this concept called consumptive use. Does this token in question have a consumptive use? A consumptive use is very broadly, it doesn't have a definition, but you can kind of assume what it means. Is there a functional purpose to it? Does it do anything other than carry value? And what a lot of people misconceived when the SEC came out with some stuff a few weeks ago was that the SEC was blanket stating that all tokens were securities, which was not the case. The SEC was very specifically issuing some ideas on what the DAO was, and the DAO was, to anybody who paid attention, you didn't need the SEC to tell you it was a security. It was a thing that paid dividends. So it was very obvious to get to that conclusion. But they've left it a lot more vague around whether everything else is a security. So the best you can do is just seek advice, and that's what many of us are going through the process of doing. And hopefully there's a lot of precedents that come out from some of the early trailblazers that can be used for kind of projects that follow. So the enormous amount of money we're spending on legal hopefully serves you someday.
Another question in the back?
Hi, my name is David. I operate an online Bitcoin exchange in Quebec. And I contacted Revenue Quebec to find out if I had to charge sales taxes when selling Bitcoins. And they told me that they take the position that I have to charge sales taxes. I know that CRA has the same position. I was just wondering if you're selling an ICO, do you know if the government considers that to be a product where you must charge sales taxes?
That's a really good question. Anyone want to tackle that?
Addison?
This is kind of like the last question. And the legal answer to every question is it depends. But in this case, it really does. What are you selling? What are the tokens? Some tokens are obviously securities. Some are coupons for pizza. Like, it totally depends what the thing is. And there isn't going to be an answer on whether all tokens would fall under this or that category. I'm sure you know this, that most crypto exchanges don't charge HST, same with the dealers, like on local Bitcoins and elsewhere. Talk to your tax accountant or tax lawyer on what exactly you're selling and whether it counts or not, which is not a very satisfying answer, but don't rely on the internet is my one bit of advice on this. Get a real answer from a professional on it.
There is a guideline or what do they call these things? I used to be a tax accountant. The CRA came out with a guideline about 2-3 years ago about the treatment of holding crypto assets, and it was very plainly stated that if you hold any type of cryptocurrency, it would be treated based on its capital gains and capital losses when you kind of enter and exit these markets. But the other thing that I've learned, having done 5 years in tax at Deloitte, is if you ask the CRA if you owe them money, they'll generally answer yes. So, probably seek tax advice before going to the tax authorities because they'll have a different answer than your tax advisors.
Your project is not a tree. You can move. And I think part of this whole ethos of this ecosystem is we are global. We are decentralized. Our team, we have a lot of, aspects of being remote and not centralized. Look elsewhere. There's lots of other friendly jurisdictions you can domicile your company in a perfectly legal and compliant way. One of the stats I like to talk about is that 30% of the U.S. global of the global capital pool is American capital, but 70% isn't. So there's 70% of the world's capital out there, and 99% of headaches are U.S. based, whether you're taking investors or domiciling there. So obviously ask your lawyer, but as they were saying in earlier panels, there's lots of really friendly jurisdictions that are options instead of just North America.
Okay, well, I want to thank everybody on stage for being part of this panel, and thank everybody for staying right to the end.